We're counting down the 10 Nevada cities facing the strongest signs of housing crisis in 2025. From rising inventory and stalled sales to towns grappling with vacant homes and budget cuts, these markets show what happens when housing supply and demand fall out of balance. Which city sits at the top of this risk ranking, and why? Let's start our countdown with number 10. Reno and Sparks, long seen as stable anchors in northern Nevada, are now showing unmistakable signs of housing strain. Over the past year, inventory in the region climbed more than 25%. According to the latest Washoe MLS and Rocket Homes reports, homes that once attracted multiple offers now linger, with price appreciation slowing to just 0.4% in 2025. This is a sharp contrast to the pandemic boom, when buyers flooded in from California and tech expansions fueled demand, has local agents noting a steady buildup of unsold properties. Builders, who raced to keep up with the influx only a few years ago, now face a surplus of new homes and are increasingly offering incentives to draw hesitant buyers. Yet Reno and Sparks remain buffered by a diversified economy, anchored by logistics, manufacturing, and tech employers like Tesla. While the market has cooled, the area's broader job base and steady, if slower, migration keep it from the acute distress seen in smaller or single-industry towns. For now, the risk in Reno and Sparks is real but measured, setting the stage for even more vulnerable cities further down the list. Carson City, Nevada's small but storied capital, is facing a different kind of housing test in 2025. Here, the market's slowdown is measured not just in numbers, but in the quiet persistence of for sale signs along tree-lined streets. Local MLS data shows the median home now lingers on the market for more than 90 days, a full month longer than the state average. In some neighborhoods, prices have dropped by as much as 15% compared to last year, with sellers quietly trimming asking prices as offers remain scarce. The city's aging population, once a stabilizing force, has become a double-edged sword. Retirees are less likely to buy, and many are holding on to homes rather than trading up or down. State government jobs, a backbone of local employment, have seen little growth, limiting fresh demand. Agents report that open houses draw only a trickle of visitors, and sellers are increasingly forced to choose between deeper price cuts or waiting out the slowdown. Without renewed job growth or a drop in mortgage rates, Carson City's housing market may continue to stall, leaving both buyers and sellers in a holding pattern. Elko stands apart from Nevada's larger cities, not for its size, but for its dependence on a single industry: mining. In 2025, the city's housing market is feeling the weight of that reliance. As gold prices slipped and mining companies scaled back, local job cuts rippled through neighborhoods. The median home price in Elko dropped to about $345,000, a decline of nearly 9% year over year. For many, the downturn is more than a statistic. Landlords who once counted on steady demand from mine workers are now slashing rents, hoping to fill empty units. One resident, whose family has lived in Elko for generations, described quiet evenings where entire blocks seem empty, a far cry from the boom years. The city's vulnerability is clear. When mining slows, so does everything else. Unlike Carson City's government stability or Reno's diverse employers, Elko's fortunes rise and fall with the mines. If commodity prices recover, the market could stabilize. But for now, homeowners and investors face uncertainty with every new jobs report. Henderson, just southeast of Las Vegas, offers a split-screen view of Nevada's housing market in 2025. On one side, the city's luxury neighborhoods, anchored by gated communities and new custom builds, continue to attract buyers, buoyed by cash purchases and out-of-state wealth. This segment remains steady, with high-end listings selling near asking price and agents reporting only modest increases in days on market. But the story changes quickly in Henderson's mid-tier and older subdivisions. Local MLS data shows a surge in active listings, with inventory up more than 30% compared to last year. Homes priced between $400,000 and $600,000 are staying on the market for over 90 days, and price reductions have become routine. The spring brought a new wave of pressure, as hospitality layoffs swept through area resorts and casinos. Press releases from major employers like Wynn and MGM detailed job cuts that reached up to 1,400 positions per firm, sending a ripple through neighborhoods where many workers own homes. Mortgage delinquencies and panic listings followed, especially in tracts built during the last boom. One agent describes a growing backlog. For every luxury sale, there are 3 or 4 mid-tier homes that just sit. Henderson's contrasting fortunes reveal how economic shocks can widen gaps within a city. While the luxury market's resilience offers some stability, the growing backlog of unsold mid-tier homes and the feedback loop from job losses push Henderson higher on the risk list. Without a rebound in local employment or a drop in rates, the city's housing stress is likely to deepen before it eases. Douglas County, home to Nevada's Lake Tahoe communities, faced a sudden jolt in 2025 that set it apart from other markets on this list. The spark came in early spring when county commissioners debated new short-term rental caps aimed at curbing investor-driven vacation rentals. Public hearings grew heated, with full-time residents pressing for stricter limits and rental owners warning of economic fallout. As the debate unfolded, local MLS data recorded an immediate spike in property listings, up more than 40% in just 8 weeks, the sharpest increase in the region's recent history. Investor sentiment flipped almost overnight. Owners who had counted on steady income from short-term rentals rushed to list properties, fearing that new restrictions would gut their returns. County commission minutes capture the urgency. One investor described the moment as the spark that lit a firestorm in real estate. STR booking platforms reported a sharp drop in summer reservations as uncertainty rippled through the market. Neighborhoods once bustling with weekend visitors saw a string of for sale signs appear, especially in areas with high concentrations of vacation homes. Unlike gradual slowdown seen elsewhere, Douglas County's housing stress was triggered by policy, not just economics. The sudden surge in listings, many of them former STRs, created a glut that outpaced local demand. Agents noted that homes lingered on the market well into peak tourist season. With price cuts accelerating by mid-summer, the outcome? A visible oversupply, investor sell-off, and a market now defined by uncertainty. Douglas County's experience stands as a warning of how local regulation can reshape housing risk overnight, pushing it higher on the list than more insulated markets like Henderson. Mesquite stands as a stark example of how housing market stress can move from spreadsheets to the landscape itself. In 2025, the city's outskirts reveal a patchwork of unfinished subdivisions, streets lined with concrete pads and wood frames, but few completed homes. Public permit logs confirm that multiple residential projects, approved during the pandemic boom, were halted between late 2024 and mid-2025. These sites remain in limbo, with developers citing a lack of buyers and mounting construction costs as reasons for the pause. Contractor payment disputes add another layer to the story. Local court records show a rise in mechanics' lien filings, as electricians, framers, and landscapers seek payment for work completed before projects were mothballed. One contractor speaking outside a stalled development near the Virgin River described months of uncertainty. "We finished the infrastructure, but the builder just stopped returning calls." For Mesquite, the risk is not just about falling prices or slow sales. It's written into the physical environment. Empty cul-de-sacs, piles of unused materials, and warning signs posted at half-built homes paint a picture of a market that overreached. Unlike policy-driven slowdowns seen elsewhere, The evidence here is visible and tangible. Unless demand from retirees and second-home buyers returns, these unfinished neighborhoods may linger as reminders of a market that built too far, too fast. Out beyond the city lights of Las Vegas, the outer exurbs are facing a housing glut that few predicted just a year ago. In 2025, inventory in these fringe communities, places like Mountain's Edge, the outskirts of Inspirada, and the Apex Corridor, has soared by nearly 77% compared to last year. Local MLS data and industry trackers confirm that thousands of newly built homes, once snapped up by out-of-state buyers, now sit vacant or unsold. Price drops have followed swiftly. In several of these zip codes, median sale prices have fallen by more than 22% since their 2024 peak, with homes that once listed for $490,000 now struggling to fetch offers in the high $380,000 range. This rapid reversal traces back to the feverish pace of construction during the pandemic boom. Builders, banking on endless demand from California transplants and investors, raced to secure permits and break ground on large tracts of land. By the time these homes hit the market in late 2024 and early 2025, buyer demand had cooled and mortgage rates hovered above 7%. The result? Row after row of brand new homes, many with no offers after 100 days or more on the market. Agents report that nearly 40% of active listings in some exurban neighborhoods are builder-owned, with aggressive incentives and price cuts now the norm. For sellers and investors, the risks are multiplying. Carrying costs mount as homes linger unsold, and the hope of a quick rebound dims with each passing month. Without a significant drop in mortgage rates or a renewed wave of migration, the outer exurbs of Las Vegas remain exposed, caught between overbuilding and a shrinking pool of willing buyers. North Las Vegas, once a magnet for rapid development on the edge of the metro, now stands out for the sheer concentration of unsold homes in its sprawling builder tracts. Internal memos from major builders, including D.R. Horton and Lennar, document a decisive halt to new construction phases during the first half of 2025. These documents cite an unexpected surge in unsold stock and project carry times exceeding 8 months, a direct response to a market where demand has vanished faster than anywhere else in the region. In certain neighborhoods, entire blocks have sat vacant for more than 150 days, double the state average. MLS analytics confirm that inventory in these concentrated tracts has jumped over 45% year over year, with dozens of new homes listed side by side, none finding buyers. Vacancy maps tell a stark story. Clusters of empty homes stretch across recently completed subdivisions, while parcel data shows a growing patchwork of lots where construction was paused midstream. Local agents describe a market where offers have dried up, and sellers, both builders and individuals, are left weighing steep price cuts against the mounting costs of holding unsold property. In response, some developers have begun renting out model homes or offering stacked incentives, but even these measures have failed to move the needle in the hardest-hit areas. The absorption lag in North Las Vegas is deeper and more persistent than in any other part of Clark County. This backlog isn't just a statistic. It plays out in the daily choices of families and investors who had banked on a quick sale, only to find themselves trapped in a holding pattern. Without a sharp rebound in local job growth or a significant pullback in new supply, the city's industrial fringe is likely to remain locked in this cycle of stagnation, setting the stage for even greater fiscal stress as the risk migrates outward to more vulnerable communities. Pahrump and the wider Nye County region have long been seen as havens for affordability in Nevada, but in 2025, that promise is under threat. County treasurer records show a sharp rise in pre-foreclosure filings, with dozens of new notices appearing each month, many linked to homeowners who bought during the pandemic surge and now face job loss or mortgage resets. On the public tax default list, Addresses that once belonged to retirees and working families now signal distress, as property tax payments lapse and the risk of forced sale grows. The consequences ripple beyond individual households. At a tense Nye County budget meeting in July, officials debated whether the library could remain open for the rest of the year. With property tax collections falling well short of projections, the county is weighing cuts to fire protection, senior services, and even basic road maintenance. Audio from the meeting captured the urgency. "We can't keep the lights on with last year's revenue," one commissioner warned, while another asked, "Who will pay for these empty streets?" Local service cuts hit hardest in neighborhoods where home ownership was already fragile. Residents describe a sense of unease as fire response times lengthen and the library cuts hours. One homeowner, now behind on payments after a layoff at the local casino, described receiving both a pre-foreclosure notice and a letter about reduced public services in the same week. For many, the fear is not just losing a home, but watching the fabric of the community unravel. Pahrump's predicament is driven by an affordability gap. With home values still hovering above $300,000 and local incomes lagging, the margin for error is thin. As more properties slide toward default, the county's fiscal base erodes, creating a feedback loop of stress for both families and public institutions. Without a turnaround in local employment or a boost in outside investment, Nye County remains one of Nevada's most vulnerable regions, where housing distress and public service decline now go hand in hand. Far from Nevada's metropolitan glow, a cluster of small resort and remote towns now face the sharpest test of housing resilience in 2025. Places like Ely, Tonopah, Pioche, and Laughlin, once buoyed by seasonal tourism or the promise of mineral wealth, are contending with vacancy rates that have climbed beyond 20%, double the level seen in any urban market this year. Local property records and postal audits confirm entire blocks with empty homes, some dark for months, as out-migration accelerates and few newcomers arrive to fill the gap. Price declines in these communities are equally severe. In Ely, the median home price has fallen by as much as 22% since early 2024, with White Pine County assessors documenting a steady stream of forced sales and properties lingering for over 120 days without a single offer. Tonopah and Pioche show similar patterns. Housing authorities and county audits report vacancy rates between 22 and 26%, and price drops nearing 20%. Especially for older homes and investor-owned stock. In Laughlin, the casino corridor's slowdown has left condo complexes and resort-adjacent subdivisions with more than 1 in 5 units vacant, pushing prices down 12 to 15% and leaving owners with few options but to slash asking prices or hold out for a distant rebound. The roots of this distress run deep. These towns depend on fragile economic pillars, mining cycles, tourism swings, and a shrinking retiree base. When mining layoffs hit Ely and Tonopah, the loss of jobs echoed through every neighborhood, leaving behind empty rentals and abandoned yards. In Laughlin, a drop in hotel tax receipts, down nearly 10% year over year, signals fewer visitors and less spending, compounding the housing crunch. For Pioche, the absence of a strong employment base means even modest population losses translate into visible, lasting vacancy. The social fabric is showing strain. Local service cuts, from library closures to reduced emergency response, are now regular topics at town hall meetings. Realtors describe streets where lawns go uncut and mail piles up, while remaining homeowners worry about declining property values and the slow erosion of community life. In these places, the housing crisis is not just a matter of numbers. It's a lived reality, visible in shuttered storefronts and the silence of once busy neighborhoods. What could reverse this decline? Analysts point to the need for renewed job growth, a revival in tourism, or targeted federal investment to stabilize these towns. Yet with economic headwinds persisting and few signs of demographic turnaround, the outlook remains uncertain. While not literal ghost towns, these communities now embody the highest risk for housing distress in Nevada, where high vacancy, steep price drops, and limited economic lifelines combine to create a precarious future. From Reno's post-boom slowdown to the stark vacancy spikes in Nevada's smallest resort towns, this countdown has traced how a once red-hot housing market is cooling unevenly across the state. The most shocking entries, like small rural communities facing 20% plus vacancy and price drops, show just how quickly fortunes can reverse when migration slows and jobs dry up. Across all 10 entries, the common threads are surging inventory, longer waits for offers, and growing signs of market stress, whether from oversupply in Las Vegas exurbs or fiscal strain in places like Pahrump. What sets these cities apart is a mix of economic fragility, reliance on a single industry, or the aftershocks of speculative overbuilding. But as the data shows, ghost town is no prophecy. Many markets are just adjusting, not collapsing. The real takeaway: Nevada's housing risks in 2025 are about local fundamentals, not panic. For buyers, sellers, and investors, understanding these patterns and watching the warning signs will be key as the market continues to find its footing.